Well, I think we're ready to get started for the deep dive this morning. Welcome. It is the 18th of April, halfway through April here, and glad to have you on for the deep dive this morning. We're going to talk about affordability. Rising prices and rising interest rates are certainly a big topic in real estate right now. And so we're going to cover that this morning. Was asked by a deep dive watcher, longtime watcher, D. Irby, last week. So I thought we'd cover that this week. I'm going to get started here. Let me share my screen. I think there's certainly a reality of this. And I want to start out with a sort of a tweet here from Allie Wolf. We follow Allie and use a lot of her quotes. She said, talk to a loan officer about rates. And he said, mortgage rates are definitely impacting buyers right now with little reprieve in sight. I'm having to get creative on the financing side to make things work. She comes back and says, probably fine, but some PTSD hearing creative and financing in the same sentence. No doubt with the rise, in interest rates, the rise in prices, you're going to see more financial products that help people, afford things, maybe adjustable rate mortgages. Back in the housing crisis, a lot of people were in adjustable rates, prices, and rates shifted, meaning, the payment started to rise and the home was worth more than worth more than what they could get for it. They walked away, gave adjustable rate mortgages a bad name. Certainly adjustable rate mortgages aren't bad. They've been misused before, but I think you'll see some more different financing products out in the market with certainly the rise in interest rates, folks looking for things to help them afford more. The Harris poll says we found that 84% of Americans plan to cut back spending as a result of price spikes. It's also changing consumer behavior in some unexpected ways. More than 7 in 10 report feeling the effects of inflation in gas prices and groceries. Certainly, across consumer goods, gas prices and groceries being two big leaders in inflation. We all feel it when we go to fill up our car, go to the grocery store. It just costs more today, and housing is no different. The last couple of years we've seen this, escalation in prices like we've not seen before, and now we see this rise in interest rates, and it's hitting people in the pocketbook. So, if we want to sort of quantify what that looks like, the change in mortgage rates, we put together a graphic, and all these slides you can download as a KCM member and change them to what maybe most appropriate for the area that you're in. But if you took a $360,000 loan amount and you started to calculate the payment based on where we've been, where we're going, you look back at January of 2021, so a year and 4 months ago, if you financed $360,000, that payment was just under $1,500, $1,465 to be exact. You fast forward to maybe the fall of this year, call it 5.5%. You can put in there what you believe that to be. That's up over $2,000, $2,044 to be exact. A rise in cost there of about $580 just in the last year and 4 months. We've seen this, escalation in interest rates, and it's costing people more. We've always said, over the last several months, homes aren't unaffordable. They're just less affordable than what they've been. And I mentioned before, as we got started, Dee asked last week about affordability, and do we have the latest affordability graphics? We do. I'm going to share those with you here. But no doubt, homes are less affordable today than what they've been in the last couple of years. Home affordability is based on prices, interest rates, and wages. And low interest rates of the last couple of years have allowed us to sort of outrun rising prices and keep affordability within good standards. But as these rates rise, as prices rise, it starts to then eat into affordability. What we use here at KCM is the Housing Affordability Index, which is published by NAR. If you've seen this before, the way you read this index is the higher the index, the more affordable a home is. And what stands out are kind of the bars there in orange, the years when distressed properties dominated the market post 2008. You see, I think it's 2012 there being the height of 197 in that affordability reading. Now, if you're somebody who wants to go deeper in affordability, like I always say, inside the notes of these slides are the links to these reports, which will give you the methodology for how the affordability is calculated. We'll give you all the information you need if you want to go deeper in it. But right now we sit at 135 in the affordability reading. Why is this important? Well, when you start to look at this going all the way back to 1990, which is the graphic here, you can see certainly homes are not as affordable going all the way back to, I'm going to say 2008. We've been in more affordable scenarios in this country, and even in the last year, in some very affordable situations in housing. But if we look, before 2008, homes are more affordable today than they were back then. Remember, the higher the reading there, the more affordable a home is. As that goes down, it means homes are becoming less affordable. So that gives you perspective. When somebody says, hey, you can't even afford a home today as compared to when? Well, as compared to the last 10 plus years, I would certainly agree. It's not as affordable as the last 10 years, but prior to then, certainly we're more affordable today, and you can see the differences based on the particular year that you want to compare things to. But no doubt, we're seeing affordability erode, and that means there's less buying power for those that are buying. If we look at affordability limits right now, this is a look at normal lending standards as compared to previous years. Now, 28% as a normal lending standard commitment of income. This is, if you took the monthly principal and interest payment as a percentage of income with 20% down on a median priced home. A median priced home in this country about $360,000 this year. So it's certainly going to be a multiple of that in some markets, maybe a little bit less than that in others. But if you see today, right there, the far red bar, 29.1% of someone's income dedicated on average to the median priced home. And so we're certainly knocking on the door of those limits, above those limits slightly. And you can see where this compares. Just the third quarter of 2021, 22.4% committed to a mortgage payment there. And just this rise in interest rates has contributed to this lack of affordability. And you go back to 2007, you see it was even higher at 34%. But we're going to continue to watch this because affordability is a concern. We want to see more people be able to buy homes, and we know the challenge that those on the lower end of the housing market, of every market, have in affording a home, and we want to see them be able to afford those homes. So as we move on, a couple other things here. First, Bill McBride says this. If you followed KCM, we've referenced Bill McBride many times. He runs the Calculated Risk blog. He said, based on the current estimates for the peak Fed funds rate, that's when you hear the Fed is raising rate, the 30-year fixed mortgage will likely peak between 5 and 5.7%. There's some variability in the relationship, so we might see rates as high as the 6% range. And he goes on to say it depends on inflation, Fed funds rate. So somewhere between 5 and 6%. The average right now, Fannie Mae is saying 5%. Some saying a little bit higher than that. It's certainly a rear view look, 5.25, wherever that is, particularly on the index that you follow. Rates have risen over 2 points, since the beginning of the year, and expected to rise and peak somewhere in the 6% range. Reason I bring this up is many people are asking, okay, what's going to happen as we go throughout the year? And I'll reiterate what I've said, what experts are saying, is expect rates to continue to climb, but not at the rate they have here in the first 90 days. Because that's sort of priced in with what they see the Fed going out and doing. But no doubt it's going to cost more to buy a home between here and the end of the year. That'll give you a little bit of material to develop your expert market opinion. One thing I do want to end, I sort of put this slide in just to give you perspective on the market. And it came from the MBA, and here's what they said. Nobody really knows what's going to happen in the next year. And the reason I bring this up is don't let uncertainty or what you fear to be information you put out in the market not being perfect. You've heard me say this before. Nobody can give you perfect advice right now. But what you can offer people is your expert market opinion based on what experts are saying. Nobody's got a crystal ball and can accurately, absolutely predict the future, but we can look at what experts are saying and say, this is what we see happening. if those experts change what they're saying, we're going to bring you that update. So always remember that. Don't let perfect get in the way of your expert advice, because many people are looking for perfect advice or may stumble over that and say, you know what, I want to have perfect advice as we get into this market. Nobody's able to give you perfect advice. So I'm going to pause for just a minute. Do we have any questions that folks have?
I actually haven't seen any questions come through this morning, Dave. Lots of good conversation, though.
All right, good. Good. Well, affordability is certainly a hot topic here. I'll go back to this slide. If you want to get an in-depth look, go download these slides inside the KCM member area. Go into NAR's Housing Affordability Index. It'll educate you on where affordability is today and where we see it, historically, and you can certainly talk about that as compared to interest rates in the market that you're in. So I'll wrap up on that. As always, grateful for everybody on Monday mornings that joins us for the deep dive. We'll see you back next Monday. Actually, we're going to have a guest host, Sarah will be in from our team, and she's going to be talking about a new resource that we're developing for you that's coming out this week. And it's all about video. I don't know what you're doing with video right now, but one thing is for sure, video is performing better on social media right now than anything else. So if you're not making videos, you're going to want to look for this resource that we're building at KCM. It's called Video Masterclass, and it gives you everything you need to know to make great videos. So you're going to want to tune into that next week. That'll be coming out this week. Take be on the lookout for that. I don't have a link for you right now for that, but be on the lookout for that this week. Hope you have a great week. Thanks for joining the deep dive, and we'll see you back next week. Take care.